All right, what's up, everybody? I'm here with Jake Harris. Jake Harris is the managing partner at Harris Bay. I love Jake's bio that he has online. He says, and I'm going to read it from Jake's perspective. Jake goes, "What I do and who I am most accurately can be described as real estate. I use my superpowers of passion and ability to methodically sort through vast amounts of data to make real world decisions on investments, development, and the management of real estate. As a serial entrepreneur, I've been starting and running businesses for most of my life. My true passion has always been real estate. I'm now blessed to have the opportunity to manage, run, and execute several operations that allow me to embrace that passion fully." So that was again from Jake's perspective there. Harris Bay is a investment firm that focuses on boutique firm, actually, I guess in Jake's words. They use fundamental, opportunistic, and value add investment strategies that, combined with their years of experience in real estate and capital management, allow them to deliver returns that outperform established benchmarks. Jake, at his core here, is a real estate guy. Obviously, from those bios, he focuses a lot of his time on development. But most recently, he actually just published a book called Catching Knives. And he really spoke about his 2 decades of experience in real estate, construction, and investment management, talking about opportunity zones, infill development, cost control systems, the scaling of distressed investing. And I think that's really where the focus dives into is really how to maximize a distressed market. Jake, what did I miss on your bio? Who are you? Tell me about yourself.
Man, that sounds fantastic. That's like that might be one of the. This is recorded. I'm gonna actually send this to my mom later and look at this and be like, "Hey, mom, check out. I'm something. I'm a unique, special snowflake, just like you said I was." I'm a father. I'm a husband. And that is obviously, I think, the guiding things of first and foremost. When things are good with my wife, she is the axis in which my world spins off of. When that is good, everything else kind of plays out in line. And so, like you said, real estate. I do lots of real estate. I do real estates in all different fashions, forms. I dream about it. I sleep, eat real estate. I love it in every single fashion, and it has been the last 20 years or so of my life. And before that, and actually, if you pull that all the way back, we fixed up an old house built in 1888 when I was a kid, and we lived in a 16-foot camp trailer, a family of 5, while we
Oh,
fixed up
wow.
this old farmhouse. And I have pictures of me carrying sheets of plywood and bathing in a wheelbarrow on a construction site. So although my professional career has been the last 20 years has been an investor, you can actually see back to maybe the existence of even my upbringing was on a construction site. And so you can kind of say that it's always been something that I've done.
I love that, man. I love that. And I specifically love that when your home life is solid, everything else is easier or unnecessary. To throw in that allusion to Gary Keller's One Thing, and I couldn't agree more. When I had this funny couple days ago, I had this big idea that I wanted to go after, and I pitched it to my wife originally, and she was just like shutting down because she was just thinking like, oh, what about this and this and this and that, and she was just like, I don't know about this, and I like went back outside to think, and I'm like, all right, let me put on my empathetic hat here. I have somebody who is scared about me taking my time away from her or this or doing that, or scared about too much frustration or something. I'm like, all right, I need to revisit this conversation. I went back into it with an empathetic approach. Here's why I'm doing this, and I was like, and I won't do it without your buy-in, because if I don't have your buy-in, it can't be done. So I think the piece on the home life being well is crucial, and I love that that's a centric component for you. So you published Catching Knives, and I'm going to start with that, and then I want to kind of work a little bit backwards. Before we started recording here, you talked a lot about how some people come to you for advice, and it started to pile up so much that you couldn't help as many people as you wanted to, and so you pulled together a lot of information so you could share with people everything that you would share with them in person to kind of help as many as you could. you know is that why you published Catching Knives? Or if not, tell me why. And then, what have you seen since you published the book?
Yeah, so Catching Knives, a guide to investing into distressed commercial real estate. Part of this was when, COVID happened. I started writing the book. I actually thought, oh man, this is it. There's going to be massive distress. The market's going to need to correct. Um, and I was wrong. The real estate tripled in value. The government went and printed $20 trillion, and everything went the opposite direction. I'm not saying that there's not distress. There are distressed assets. There are distressed deals that exist in every market. But the fundamentals, and then to your point, it was trying to convey out there some of these investor fundamentals that happen, especially in the commercial real estate world, is you have some scarcity of deal flow, and especially when it's in a distressed environment. And a lot of times, commercial assets will only sell once a generation. And when something sells once a generation, that has some scarcity to it, and it requires you to do your homework ahead of time. And that was a lot of the things that I talk about, is the fundamentals of developing a business plan and investment theory before you're actually buying the specific asset. And then you have an executable business plan, and especially when you have a short window to make decisions when there's a free falling market or distress. Those fundamentals still work in a regular market. It also works in a very competitive market because you have so many people trying to chase down a single deal, and there's so much capital flowing. The dynamics and how you're able to extract additional value is different. But that is kind of the premise. And it was like also giving young Jake the advice that I wish I had kind of been able to gather 20 years ago, because, and I talk about this in the book, is I became a millionaire before 30. And I was like, yeah, I did it. I crushed, and then I lost it all in the subprime meltdown. And I remember sitting on a street corner down in Tucson. Dear Lord, can I be worth $0? No money. Because I had a negative net worth, because the portfolio that I had, the debt I owed was more than what they were worth. And so I had a negative net worth, and I wanted to start over at zero. That would be awesome to have no money. And so that was, and I convey some of those experiences and things that I didn't do properly that led to my ultimate demise. And especially, and trying to help out other people, is trial and error. Making mistakes is a very, very effective teacher. You learn, but it is not the smartest way to learn. Wisdom is seeing other people's mistakes and avoiding those and using that. So I was a little bit dumber and had to go slam my fingers in the drawer and go touch the hot stove and make those mistakes. And I'm just saying that, again, that is a very effective teacher. You don't have to do that. Can I give younger Jake advice? This is a little bit of my advice to younger Jake or other people that are looking to invest into commercial real estate. Is these are some of the things I wish I knew before, and then to lever and to help more people. And now it's sold, hundreds, and I think into the thousands of people have bought the book so far. And so I'm hopeful, at least the feedback that I've got, is that it's valuable and insightful to the people that are looking for that particular thing.
I love that, man. Wow, so much to unpack there. You know, First and foremost, thank you for putting something like that together. You know, I'll put myself on blast. I actually have not read it yet, but I'm gonna go order it right after this. And I'm gonna read it myself. I've listened to a lot of stuff you put together. And I read a lot of the stuff you put together, but I need to go get it. But I love a couple of the components that you talked about in there, and I can especially relate to learning the hard way, despite people giving you certain pieces of advice. And I'm very hard-headed myself, and I told you right before, some investments that I made, I learned a lot of lessons the hard way, sold off everything, and then now I'm repositioning a portfolio and starting to make new investments with the new information I now have, and it's a totally different ball game. The one I just purchased last week, I have a full due diligence folder. I have everything that I need. I have all of my scopes of work. I have all of my plans. I literally have everything pulled together. I'm ready to go to get it rented, and I feel the most prepared I've ever had in my life. And I closed last week. And on one of the projects that was the biggest one I ever had, I completely had changed all of my plans for construction and everything literally weeks after I closed, and it's just, I didn't have it all together. And it's, but you learn, and it helps. But I wish that I had listened to some people more and asked, maybe even ask just better questions. Sometimes I felt like early on when I would go into a project, I just wouldn't ask the right questions because either I knew that I didn't want to hear the answer, or I just didn't know what questions to ask. And I think that's another key component. Something that you said, first off, was how you had started writing this book in 2020 when COVID happened, and then nothing that you thought was going to happen happened. Talk to me a little bit about, I guess now we're here. It is February of 2022, so it's officially 2 years since COVID really broke here in the United States. I guess March 14th or whatever was when they started making announcements, at least in our state, Maryland, that I'm in. Tell me about, retrospectively, a quick run through of what you really thought was going to happen with commercial real estate, and then where we currently stand now, with a caveat, a subset of that, in the sense that commercial real estate is sticky in economic terms. It does not move quickly. So why, like, what made you think that real estate, commercial specifically, was going to shift so quickly? And then why do you think it didn't? And where do you think we stand now? I know that was a lot of questions, so you could just answer one, and I'll jump into the
Yeah,
others
so
later.
why I thought there was going to be distress was especially around like hospitality. It was the first time ever that hospitality, went to zero. Like, even during 9/11, and, obviously things have, in Ukraine have kicked off recently, and, war, is still sometimes economically okay from a business perspective, or at least commercial real estate, because it provides a hedge. And so it was looking like we were gonna experience kind of a deflationary environment with travel and transient, kind of leisure travel going to zero. And I was talking out there to some of these hotel groups, and they're like, it was the only time in the history of our 60, 70-year history did it go from this to zero. And they're like, we don't know what we're gonna do. And that was also, if you looked at retail. So retail had a similar component. Restaurants, zero, like it dropped off of a cliff. And so there was just so much unknown, and so many things that is just like it never happened were now happening in that commercial real estate world. What happened was the government went and printed a lot of money. So they gave out PPP loans. So that basically papered over the ability for a hotel operator to stay in business for a year or 2 years, or that restaurateur or whatever, to just like, we're kicking the can down the road. And then what happened is subsequent like to-go orders picked up for some of the restaurants. The 50% of the country was like, hey, we're okay traveling, and they went back to traveling. But then the fact that the government printed $20 trillion is, instead of being at a deflationary environment, now we're in an inflationary environment. And so there's a whole lot of things that happened in the last, call it 2 years or 18 months, that effectively have changed the makeup of what I was seeing as opportunities of distress. Work from home is the thing. Office is a little bit slower to recover. There's people that are not signing new leases, or considering maybe downsizing some of their office presence right now. So we're seeing some areas and some asset classes that are maybe a little bit less desirable. That's maybe where you can pick up some opportunities and deals. And there are some things that got just kicked down the can down the road. And we're starting to see those now come online or come on the market in 2022. They weren't the deep distress of a hotel that was shuttered. It was like, hey, we're still a hotel. We have a skeleton staff. Our occupancy is way lower. Let's just pretend 2020 didn't happen. Bake all your numbers off of 2019 and we'll pretend we're going to get back to that relatively soon. And so that's what I see this happening. And so stuff's transacting. Also, subsequently, what has happened is everybody prepared and took down funds. There's so much money out on the street right now. Everyone was clamoring and they're like, everybody thought that's it. This is it. It's distress. We're going to buy up everything for pennies on the dollar. And then it didn't happen. And so now there's just so much pent up money that they're all chasing down very limited deals. And if you have 50 people trying to buy one property in Maryland, well, guess what? That means there's 49 other buyers that didn't get the deal. So they subsequently need to go find something else. And that's caused this frenzy of compressing the cap rates and pushing everything up because they want to not be sitting on cash in an inflationary environment. And then I think it's also, it used to be really great to have like a 10-year lease term with 2% bumps annually. Right now, when you're looking at a 7.5% inflation in the year, and you're like, do we really want to buy something that has a 10-year lease?
Hey, that's just transitory. Just transitory.
Right. And so they're like, well, let's move to self-storage. Maybe let's move to hospitality. Let's move to multifamily, move to something that, turns over their leases a little bit faster. And so that's subsequently what has happened, which I did not predict. I didn't even predict an epidemic or pandemic in most of our deals. The book was a response to, I thought there was going to be a lot more distress than there was.
Sure. No, I'm with you on that. A couple of things there. Obviously, the government printing almost an entire year's budget, right? I mean, it's unreal.
80% of all the money in existence was printed in the last 18 months.
Yeah, it's
80%.
Unreal. And I piggyback on that in the sense that, PPP loans majority of them were forgiven, right? And then of course, SBA is paid back, but it's paid back over 30 years. So people just have these low payments on the low interest rate on this capital that they got, and they're just sitting on, just waiting to spend. Now, one interesting component I did look into, and this is just a small little caveat, but do you think PPP really did keep the hotels afloat or the restaurants? And my only reason I ask that is because in our regions, we heard a lot of pushback from the hospitality people because the PPP loan required them to be at full employment. And they didn't have the ability to really to be able to have their staff at full employment. They would have had to have a whole lot of other overhead that they couldn't afford because people weren't able to go in and utilize them. So PPP loans for hospitality in our area actually didn't help as much as SBA loan did. Really in our area, we were just very insulated, I think, because we're so dense in this Northeast region that we just didn't see fallout for that insulated reason. But the PPP wasn't really a savior, at least for hospitality specifically. For many others, it was. Do you think that was a big component in your markets?
It depends. And yes, it was, because maybe they went to a shell of a staff, but they were able to pay their mortgage payment for a year. As far as when they had no revenue, they had no staff, but at least, and maybe it was round one of PPP. I know for restaurants, it very much kept a lot of restaurants in business. My brothers both have restaurants, and they're like, hey, we were able to take advantage of this, keep our staff going, keep us. And really what happened was you had like half of the restaurants went out of business in the area. And so the half that survived also became even more busy. And so, now they have employee issues, is like they can't hire anybody because a lot of people got unemployment wages as well. And so I think as a whole, it helped, again, kick the can down the road. So if you were making $40,000 a year on unemployment doing nothing, you probably don't want to go back working at a restaurant short term, that was problematic also from hotels is their housekeeping staff or their, their porters or the bellhops or whatever. When their, occupancy went to nothing, they're like, hey, sorry, we got to let you guys go. And then to try to bring them back also cost them a lot of money as well. But they were able to pay mortgages for a year. And, a lot of mortgage holders also were a lot more flexible for that given time period as well. That first year of 2020, where they're kind of like, we don't know what's going on either. We'll try to figure out something. We'll work with you on you making your payment. Coming into 2021 and then now subsequent 2022, like they're not working with you anymore. They're like, if you can't make your mortgage payments, sell your property.
Yeah. Yeah, no, without a doubt. I have one more question on and kind of on this topic, and then I do want to jump into development and talk about that. And that question really revolves around multifamily, self storage. Those are typically shorter term contracts. Or I say short term, 1 year, maybe less than a year, maybe 2 years, something like that. And so they're going to be able to respond to changes economically much faster than potentially other commercial leases. You mentioned that having a 10-year lease now potentially could be a liability if it's not tied to CPI or inflation or something of the sort, and it's a fixed escalation. Do you see a potential future fallout that hasn't happened yet, specifically because there's potential that a lot of leases that are still going through to the end of their term are from businesses that are just paying it out and then not going to renew or not going to find new space? I mean, do you think there's going to be a fallout there with that reason specifically, or do you think, I guess, because there could be a fallout because the money's dried up as well. So I guess the better question is do you think a fallout still has not occurred yet? If so, why? And are one of those two reasons the main factors?
I mean, I think that's still very tenant or specific to the individual case. Some businesses I'm seeing are downsizing. They're not renewing, or they're renewing less on, like, say, an office size, because they're allowing people to work from home more. The data is coming back that people are not as productive working from home.
Yeah, no.
They are not. The CFO is looking at it like, man, look at how much money we can save if we downsize all of our offices and we don't have to have 100,000 square feet. But HR or the production managers and other things is like, we need some of these people back together. Humans as a whole are tribal. We need to connect with other people. The Zoom is a very valuable tool, but it is not the same as working in the environment, and especially in a work environment. The number one reason people leave an employment is because of a lack of friends or connectivity. It's not money. And so I think if you want to go to a completely mercenary kind of workforce, what that ends up being is it costs you a lot more, and you have more turnover of your employees. And I think most people prefer to have that stickiness of almost kind of like a secondary family. Now, how that plays out, I have no idea. I don't have any way of trying to predict that. What works well, what doesn't. Some of that is related to politics. I know that California, the West Coast, the Northeast are doing really, really amazing and fantastic jobs of driving people out of the West Coast and the Northeast. They're driving them, really to the Carolinas, to Florida, to Texas. They're pushing them other metros over where it's lower taxation, call it politics, whatever you want to call it. There's certain reasons from climate, from ease of work, freedom from schools to make your own choices, whatever that is, it is absolutely happening. The West Coast and the Northeast are driving people out of those areas. The dues of the quasi being part of the country club, the good weather that is in California, or the sphere of the financial world that is New York, I think is losing a lot of its appeal and luster, and people are going, I'm okay being in Florida. I'm okay being in Texas.
Sure. So do you think there in the next 18 months we'll see another shift, or do you think, or yes or no?
I don't know. I don't. I can't predict that as
My
far as
crystal
the
ball's in
thing.
the shop
Yeah,
too.
my crystal ball is really fuzzy. Um, who knows how people respond? I think midterms are coming up, the elections that may give some um, volatility to the market, to sentiment, because the fundamentals are actually halfway decent or pretty darn good. From like, we're undersupplied from residential units. You look at that as like, man, we're going to have crazy rent growth. We're going to have crazy increases from an inflationary number moving up. But fundamentals are one thing. When consumer demand or consumer sentiment shifts, it doesn't matter what those fundamentals are. So turmoil geopolitically, from fighting and wars in Europe, supply chain issues, construction costs, all of those things can cause erosion or detriment to what are some of those fundamentals. Coincidentally, sometimes with war, I think it actually benefits, and the United States may actually emerge as a continued place to where a flight to safety for capital. Do you want to place your money in Europe in a negative interest environment that is now being, volatility of war? Probably not. As far as, so then you would have money likely going and repatriate, or at least, being located in a place that they had some predictable amount of consistency, and that likely could be the United States. So I see North America, South America becoming a lot friendlier over the next decade, because geography and geopolitically, the resources and the managing of those things are going to need to flow north and south versus the east and west that it has traditionally. And so I think that bodes well for the United States from a fundamental standpoint. Could that change because of consumer demand? Could that change because of oil prices getting out of control, or supply chain issues continuing to struggle? Absolutely. And so it's very, very difficult to see how that's going to ultimately play out. And then also from a political, from the elections coming up with midterms and subsequent reaction to that politically across the country.
Yeah, well, you mentioned a couple of things there. It's actually a great transition. So, and I appreciate that answer. Thank you. I think it's funny. I always like to ask what everybody thinks will happen in the future, but it's, the crystal ball is in the shot, right? It's blurry, it's fuzzy, it's so hard to tell. And the allusion back to what you said when you wrote the book, everything you thought was going to happen didn't happen because the government just printed money. You talked about a couple of things. So I hear, I look at a lot of data. I love to nerd out on that data, and a lot of people are reiterating the exact point that you just made. Your fundamentals with supply, regarding residential real estate, and then even again geographically based, but in some commercial markets, your supply is still not meeting demand. And when you look at new construction, it's not meeting the demand. And there was an interesting stat that I actually saw in the last week or so. It might have been Scott Galloway's chart of the week, or maybe a Morning Brew chart, or something. I can't remember exactly what the source was. I apologize. I'll have to look that up for show notes. But the stat showed that right now we have, in the last 20 years, we have the most approved projects for construction ever that have not started construction. As in, all of these developers went through all of the entitlements, got everything they need to do. They have a piece of paper that says they can put a shovel in the ground, and they're choosing to not put a shovel in the ground. The most projects like that over the last 20 years right now. And I think that's a testament to many different things. You had talked about a couple of them. One of them, supply chain issues. A couple other things that we're seeing in our market specifically is with people working from home from COVID on a productivity standpoint, the staff working at municipalities are just not processing, entitlement work a fraction of the pace they used to. And so things are getting stalled from an entitlement perspective. Things are getting stalled from a supply chain perspective. But yet again, we still have the most projects approved right now ever before, and they're not moving forward. So you as a developer, I know you guys have a few projects that you're focused on right now. Some of the things that you all do is, buy land with what we call hair on it, quote unquote, and you entitle it and then maybe sell it to somebody else. I know that you said sometimes you'll develop things through, sometimes you'll buy things that are existing and you'll add some value. From a development perspective, what are you seeing right now? Like, what obstacles are you hitting right now with your development? Or conversely, what opportunity do you see with development right now?
What obstacles we're facing? Lots of them right now because it is like such a dynamic set of problems. So when you say buy out a contract, so you're developing something, an apartment building, and you buy out your contract from your subs, and meaning that you lock them in at a pricing over the next year or 18 months and then say, hey, you're going to, do this for $500,000. And they're like, yep. Well, material cost is sliding so much and they're getting exposed to this on multiple different facets. And so, could we go in and sometimes try to sue them to perform that contract at $500,000, but they're potentially facing bankruptcy if they can't adjust for their material cost. And so they held their price on day one, or 18 months ago, they thought it was going to be this, and now it's slid, over here. So then they're set up, they're going to lose money. Like they're paying us, or essentially doing this job, and not only doing it for free, but they're paying us to do the job because they're doing it for $500,000, and the material cost and the other things, cost them $750,000. So they're like, dude, this sucks. Like, how motivated are they to go lose money to complete a job because that's what they agreed and signed a contract? So that's a tough position to be in as far as the owner saying, nope, but that's what you bid. Tough, do it. And so you have to navigate some of that, and then to hold your pricing that delivers to what your pro forma is. So now what we're seeing is subs or contractors or a combination are trying to share that risk. Okay, here's the price what I'll give you from a labor perspective, and then this is what I want to hold for right now from a material, and then we share in that risk if the material cost doubles in that same time period. Great, we can at least understand and high level focus on that. But then the lenders don't like that because they're like, what if your $10 million project turns into a $15 million project? And we're like, yeah, we don't like that either. So, but you have to navigate those things, is what is the appropriate amount of money to carry as a contingency and material, and how much of this is supply chain, how much of it is inflation, and X, Y, and Z. And that's difficult. So also one of the things we're seeing is some of the stuff is just not available. So for instance, control modules for the HVAC units. That manufacturer, the engineer designed this specific ductless mini split system that goes in, that sits in there, and everything's been configured and the ductwork has gone off of it. And that manufacturer is no longer able to get those control modules, and they're not sure when they're going to be able to deliver those head units. So now what do? Do you wait 9 months? Or do you look at some alternative and, well, that specific product and that head unit is a different size. So now you have to reconfigure the space, you have to reconfigure the ductwork or the equipment or the, all of those other things. And so it may even have a different load calculation. So you have to redesign the electrical, you have to redesign, are you over the capacity for the building? And it's like all of those things that you have to, dynamically approach as they get brought to you. And so that is where the world is, and it's a difficult place. So it's not surprising to me that the most approved projects ever that are people are holding off on, because you're just like, man, it seems like you're getting put in a buzzsaw and a blender of problems that you don't even know exist yet. And until something, settles down, we're not going to move forward with it. So that also poses, exactly to your point, that is opportunity for those that do push forward, that you can go deliver product and lock in and try to get that pricing. If prices go down in the future, maybe that was a wrong decision. If prices continue to elevate up and you're just done, that could be the advantage that you have, because you have a finished product now, and were able to battle through some of those supply chain issues or logistics challenges that other people didn't want to go through. And then you have finished product, and if cap rates continue to compress and construction prices still go up, you make the additional profits of moving and creating that action. I have always been a believer that action will solve the vast majority of the problems.
Just doing something about it, you mean?
Just going. You can sit and wring your hands all you want. You can do these things. But yeah.
So are you looking at new development projects now, or are you just seeing the current ones that you have through?
So I'd say both. So we're selling off some that we were going to develop, because we're basically handing it off, passing the baton to other people. Part of that has to do with our bandwidth. Is, like one of the projects is is a couple $100 million development, $250 million development, 800 units that I entitled for. And it was like, hey, to put together our investors, this is going to take a lot of investor capital. It's going to take, the balance sheet. We don't have really the balance sheet support there. I'd rather just hand that baton off to somebody else, let them run with it. We can capture a nice value add from the rezoning and putting together that planning. Some of it we're getting ready to break ground on. We feel like we are the best candidate to take that and deliver the returns and the value. So the hotel on the Riverwalk, I'm super stoked for that. And I am absolutely doing that. And we're going to break ground the next few months on that one.
I love that, man. And I know we only have a few more minutes here. I want to be respectful of time. I guess the final question on that development front would be, on any new projects that you are considering, have you changed your strategy specifically because of the obstacles that you mentioned that you're facing right now? And how is that strategy changed? And that could be a simple answer, such as our contingency moved from 10% to 30%, right? Or that could be, we don't lock in contracts anymore ahead of time, or we have contingencies in our contract that tier out. I don't know what that is, but if you are looking at these new development projects, has your strategy changed? If so, how?
So we are looking at some of those things. We're doing a lot more pre-construction work. So oftentimes before, we may leave some of those things to be decided in the future, as far as we'll figure out, that fixture manufacturer later. But now we're like, no, we're going to figure out all of those things right now. See if there's any kind of cost or time savings in maybe pre-fabricating, pre-manufacturing something ahead of time, some assemblies or wall assemblies. We've also started looking at more domestic suppliers. So for instance, like HVAC, we source stuff that's, manufactured in Texas, for our Texas projects, than stuff that was manufactured in Korea. Because of some supply chains and chip issues, I can drive to the factory in Texas. I can't drive to Korea. I don't think you can drive to Korea. You might be able to, but it's through Russia, North Korea, and that's difficult path. So, but I was like, so some of those things we've pushed the design team to, with those understanding, is to say, hey, we think it's going to have a lower probability of going off the rails by this being a domestic supplier. Sometimes that may be a little bit higher price point because it is the domestic manufacturer, but it gives us a little bit higher level of probability that it's going to be available for us when we need it.
Awesome. Hey, man, Jake, this has been fantastic. I have one final question before we end, and I want this to just be like a quick answer for both, like as in, one word. What, and this is two questions. What asset class are you bullish on, and what asset class are you bearish on? And I don't want you to give a reason, because I then want you to tell me how people can get in touch with you or follow what you're doing, so that they can find out later on.
Yeah, I was like, I'm kind of a whore and I like all asset classes. Just depends on the price.
Okay,
But
that's
I
our
would
answer.
say what I'm most bullish on that probably surprised people is hospitality. What I'm most bearish on is retail.
All right. Interesting. Interesting. And if people want to find out more about what you're doing, how can they get in touch with you or follow along?
So catchknives.com. You can reach out there. You can join the mailing list. We put out content weekly. We have some stuff on YouTube and podcasts and other things. We also list, I don't know that we ever really talked about it, put together a net lease due diligence course. I've seen a lot of people jump into assets with very little fundamentals or research, and so put together some courses on that. That's all through that catchknives.com. I'm most active on Instagram, and that's at jake.realestate. You can find me on there, and that's where I'm most active, posting or responding and doing other things. And then you can find all the others on the catchknives.com.
I love it. Jake, thank you so much for your time, man.
Cecil, appreciate you, brother.
All right, let me see here.